Start recording. Okay, there we are. Okay, that should do it. So let's get started. One thing that often gets overlooked, or one thing that I've been asked quite a bit, is the question: how much should I put in spot, and how much should I put in futures? So I think this is one of the main things where people like kind of mess up once they get into trading, and that they think, hey, futures trading is something I can make a lot of money with. So that's why I'm going to put most of my money in. That is a thought process that a lot of people have at the start. A lot of people at the start of trading put a lot into futures. And that is very risky because futures has a lot of ways where you can lose a lot of money really fast. And some of those ways are out of your control, right? So for example, if you trade futures on MACD is famous for that, where sometimes in a massive flush, if something bad happens or like a news event or war breaks out, whatever, the market will drop so fast that it might not even trigger your stop loss. Things like that can happen on futures. So one of the most important things, and this is everything I want to go over today, so I'll put a screenshot of it in chat already, but I'm going to delete all of this and simply start from the beginning, right? I just put a screenshot here and I'm going to start over. So one thing I want to go over at the start is how you should divide your portfolio. Make it a black line. How do you actually like divide your portfolio in a way to be consistently profitable? Today I'm going to talk about two main subjects, and that's one trading plan, and the other, and that is fundamental TA knowledge. And to like quickly summarize what I mean by this, are things like market structure, and things like time frame alignment. What I don't mean with this is like things like harmonics. Those don't fit in it. That is not like a fundamental thing you need to know. Because for no matter what kind of style you trade, no matter what you do, you need to know about like time frame alignment. You need to know about market structure because those lie at the core of essentially every TA form. Okay. First part, what I want to talk about is your trading plan. How do you allow yourself to consistently grow? One thing that you need to do is you need to divide your portfolio between spot and futures. What do I mean by that? Spot, just gonna do it like this. Spot is where you like go to your exchange or go to your wallet or whatever you have, and you literally just buy the coin and you now own that coin. So let's go say I want to buy TIA, and I literally go to my exchange, I buy TIA. That's it. That is called spot. Spot has this thing where it is rather safe relative to financial markets, right? Because you now own a coin. And that makes it a lot easier to trade because let's say the market goes down a lot. Like the market goes down like 50% overnight, which happened like a few days ago, right? Well, you're now down 50%, but you still own the coin. So you still have it. So that like kind of negates the risk where, for example, you buy ETH at, let's say you bought Ethereum at like 3K, right? Well, you are now in a loss because we're now at 2600, but you still own Ethereum. And most people can agree that Ethereum will at some point in the future reach a higher level than 3K. So you will still be able to sell it for a profit eventually. That is one of the reasons why spot is something most people make most of their money on, because you can simply hold it for an extended amount of time. If it goes down, well, you can simply buy more or just hold it. That's completely fine. So if I go on a chart, for example, let's say I bought Bitcoin like over here. Like I made a mistake and I bought it over here when the ETF got approved because I was like, hey, the ETF's approved, I want to own it now. Well, I went into loss for quite a bit, like 20%, which is quite a bit, right? but you still own the coin, and it just went up after, so you can sell it for a profit later if you want. But let's say I went into a long here. I was like, hey, the ETF got approved. I'm going to go along like this. Well, your stop loss gets hit, and you're now out of your position. You now have realized loss. So it doesn't even matter that it went up after that. You have made a loss now. And that is one of the main reasons why, or just one of the reasons why spot is a lot, one, easier to trade, and two, safer to trade than futures. So one thing I always recommend for people is that you should be very careful with futures until you're profitable on spot. I don't think you should necessarily not trade futures because they are different and you can learn things while doing so. But if you are not profitable on spot, you should trade futures with very little amounts because it's a lot harder and you're gonna lose a lot more. So you should set yourself up to be able to learn like that, but to not lose that much. And then after that, this is what I recommend for portfolio management. 90% spot, 10% futures. I think this is a very good ratio. You can go slightly less at start. Let's say when you're just starting, you go, for example, like 5% futures. But in general, I think 90 to 10% is a very good ratio. And the simple reason for that is to allow yourself to be wrong. Like if your futures account gets wiped out, for example, you will only lose 10%. Like if you get liquidated, you will only lose 10%. Where, let's say, if you would be 50-50, right? You'd have 50% spot, 50% futures. And overnight, something like this happens, right? You would be, let's say you were in a bunch of longs while this happened. Where if you're 50% spot, 50% futures, you would have probably been liquidated. First of all, like no matter how much you were allocated, if you are over allocated over here in a bunch of longs, you would likely get liquidated on this, because it's not certain that the market, that some exchanges actually trigger your stop loss, right? Price is very volatile. You will likely get your stop loss on futures triggered either below where your stop loss is, or it will not trigger at all, which is something Maxi does a lot. And I keep saying that because I hate that exchange. I think it's good for scalping, but for like in events like these, it's pretty bad. But if you were on spot, well, you can see what happened right after that, right? We are currently above that candle. So if you're on spot, you're completely fine. So let's say that happens, right? And your stop loss slips and you get liquidated. Well, if you're 10% futures, you lose 10%. That is okay. That sucks because you lose 10% of your portfolio, but it's okay. It's manageable. But let's say you're 50-50. Well, that's 50% of your account just wiped out. Like you just lost half of your portfolio, which is a ton. Like that is way too much. So that's why I always recommend to stick to about 90 to 10%. And that's also why if I consistently make profit on futures, after some period of time, these two will run out of, like, they won't be 90 to 10, right? Because you can, for example, short on futures. If I'm shorting a ton, then this ratio will kind of change very fast. So then after some amount of time, if it gets too far away from that ratio, I will literally just take money out of futures, just put it into spot. Because in the end, that is how you make most of your money. You make most of your money by simply buying spot while the prices are really low. And then you just hold until it's in deep profit. Then, within those, I'm going to go over future systems in a bit. I want to go over spot management first, because I think in general the market is currently in an amazing spot for spot positions. Because if you go to most coins, right? For example, TIA, well, you could say TIA has already pumped quite a bit, right? For example, yesterday it pumped like 20%. Pumped quite a bit. But if you look at where it is in general, well, this coin half a year ago was worth 4 times as much. It's like 560 now. It used to be $22. It's like in general, if you look at coins, they are pretty underpriced. Say as well, I'm someone who likes Say, for example, or other coins, even like FET, for example, right? Pretty underpriced. So that's why I wanted to go over spot first, because in general, I think this is a pretty good spot to buy. Even if you think the market goes lower, right? Because I personally think the market goes lower. I'm someone that still thinks we see at least 50k. But even then, this is a pretty good place to like start buying spot positions. And then you don't buy everything, right? Like for example, the positions I want to have, I'm like 20 to 30% allocated on those, just in case we go up. And if we go lower, I will buy more. That's why I want to go in spot first. In spot, you have a lot of ways to manage your portfolio. I'm going to give you guys a very general way. So you can fill it in yourself between like categories and diversification and whatnot. So I'm going to give a very general way. I recommend having 2 spot portfolios. Actually, going to use arrows for this one. I recommend 2 spot portfolios. Spot portfolio number 1. Long-term spot. Long-term spot is something, and I'm not going to give these ratios, right? I personally have them, when I made them, I had them about 80 to 20. If I would remake them right now, it will probably be around 50-50 or 60-40 long short term. But I'm not going to give ratios. These are like completely up to you to decide. Long-term spot. What do I mean with that? Long-term spot are spot bags which you have very high conviction in. So for me, that would be Aave and Ondo and Bitcoin. That you simply buy at levels which you are happy with, and then you hold. Like you actually just hold. And if you ever get to the point where like 2 or 3x's, then you take your initials out. But in general, you just hold. And then you start closing those positions when you see like very high time frame weakness. So for example, on let's go to the past, right? So on Bitcoin, let's say you bought long-term Bitcoin spot all the way over here because you were like, hey, we're like starting a bull run. I want to buy this. I would hold it all the way over here. I would literally just hold until I saw some very high time frame weakness. And what do I mean with that? Well, let's look at it from a market structure perspective, right? We have our low, we have our high, we have our low, high, low, high, right? Then over here we have a lower low for the first time in a very long time, right? That is where I would start looking to sell that spot position. I would simply go to a lower high, because after a lower low comes a lower high, right? And that is where I would start looking to sell long-term spot. So for example, during small events, you don't sell your long-term spot because you want to keep it just in case you do go up, right? So for example, with Solana, I know a lot of people bought Solana long-term spot like in the 20s, right? I'm going to go on a clean chart actually. It's clean enough? Clean enough. Let's say Solana, right? I'm looking at it from a weekly time frame. Let's say you bought Solana like somewhere in this region. Then all of these moments would have been moments where you would consider selling your short-term spot positions. Because let's say you are over here, you could consider it as a good resistance area, right? Because we had like some closes over here, for which we use as support, and we use it as resistance slightly later, right over here. So you could consider that resistance, right? Pretty important level. What you do for a long-term spot is you can sell your initials here, and then you just hold it. So during all of this, you kind of just hold it until it goes up further and until it starts showing like actually very high time frame weakness. That is when you sell your long-term spot. And that way, even if you are wrong about, for example, the market dropping and going down, you will still hold that for the future. Because I think we can, most of us can agree that, for example, Ethereum, right? You would buy Ethereum here. Well, I don't know if it's going to go down first and then up, or if it's just going to do nothing, go up, or whatever it's going to do, right? But I do personally think that we will eventually at least come to this box, right? Somewhere around 4K. That's why during these moments, you don't sell your long-term spot. And that is why I recommend having it separated. So back to this, right? That's why you keep long-term spot. The other part about spot is your short-term spot. And short-term spot is for active trading. So that is for example, you see like a random coin. Let's say you see Fed, right? You're looking at Fed over here, and you see, hey, our market structure is pretty bullish, right? And we've come down for a new low, for a higher low. So you just kind of buy here, and once you reach that next resistance, that's kind of just where you sell, right? You just buy low, and you just sell, and then you go to the next play. Where you keep a little bit, right? Because it's still spot, you can hold it for a longer time. And then you just kind of start selling on weakness. That is what your short-term spot is for. And that way you can also trade coins, like for example with, or like any other meme coin. Let's say you wanted to trade Bobcat, right? You can kind of just trade it, right? Because you can say, hey, I think this is a higher low on the trend line. I want to buy that. And then you just sell it once you go up. And then you just buy, sell, recompound, all of that. That is what your short-term spot is for. So, for example, if I think the market is going down heavily, I will not have my short-term spot allocated. I will have all of it just in USDT because it's short-term. I am literally just actively playing the market. That is what that bag is for. But I will most likely not touch my long-term spot. Because in the long term, why don't I care? In the long term, I think the market's going up anyway. If you skip forward a year, I think we're higher than we are right now. So I don't touch those bags, right? Then within that, within those spot bags, there's something very important to keep track of. And I'm gonna do the same thing I did last time I explained this, and I'm literally just gonna get Archmeister's allocation for this because I think it's great. Let's see where it is. There it is. This is the same thing I follow. I got it from Archmeister. So I'll put his I'll put this picture up here as well so you can see it. I got it from Arch. This is the same plan I use, right? And I think this is great. So we're gonna go over this. 10% futures, we've been over that. Then what I wanted to go over now is a very simple, how do you allocate within those spot bags? Especially for long term, right? These numbers, you can make them for yourself. You can choose other numbers. That is completely fine. The general gist of this is that you should have more funds into large caps than you have into small caps. So for example, if you are very bullish on Sol, you can allocate quite a bit of your funds to Sol. The rule of thumb here is like 30 to 40% of your total long-term spot portfolio should be large caps. I think that's a good number to go off. So let's say you want to have like 5 coins in your long-term bags, or like 4. I'm going to go 4 because it's easy to calculate with. You want to have 4 coins in your long-term bag of for large caps, right? Then 10% of your long-term portfolio could be Solana, right? Let's say the same thing about BNB. BNB is a large cap, or ETH. Then you just make 10% Sol, 10% ETH, 10% BNB, and you just buy those at levels where you're happy with, and then you hold it until it starts showing very high time frame weakness. And you can just go down this ladder, right? So that mid caps, so let's say something like Ondo, right? So like Ondo would be a mid cap. So I would have slightly less in Ondo than I have in Ethereum, for example, because it's a way smaller market cap, so the risk is inherently a lot higher. And that is a very core concept to understand, and that is why it's important to go lower risk on lower cap coins. Is if I would compare several coins, right? I'm not gonna compare PopCap because it's a meme coin, it's unfair, right? Let's go on a random low cap coin. I'm gonna go on EFI because EFI doesn't have that big of a market cap. Let's go on EFI, right? I should have a clean chart. EFI. In general, these moves are quite big. That is like a 70% move, right? This is like a 200% move. Also went down that much, right? It went down like 62%. These are pretty big moves, right? Because the market cap is quite small. EFI is like a small cap, for example. I don't know how big the market cap actually is, but it's like somewhere around the small region. These moves are pretty big. So you don't need to put in as much money as you would into like something like Ethereum to make a good amount. And it goes the other way around as well. If you put in a lot, you also have the risk of risking a lot. So you kind of take that extra volatility into account when considering how much you want to put in there. So for coins with a small market cap, your risk to reward is a lot higher. So you put in a little bit less because you have a chance of losing a lot as well. That's why I kind of divide it like that. So if I would go on, it's like a large cap, right? I'm gonna use XRP, which is kind of cheating because it doesn't move, right? But it's good to show as an example. So if I go on XRP, I'm gonna exclude the lawsuit, right? The lawsuit's like 100% in one move. It's like 50% up. And over a very long period, we went 30% down, went 50% up again. This is a lot less than EFI because remember, EFI had like 200% up, and then it went like 70% down, and then like 70% up again, and then like 80% down. And this concept is the reason why you put less money in smaller market cap coins and more into high market cap coins. Because to be profitable, you want to stay consistent in your gains, so you want to keep this consistent as well. If I would go into, for example, with, well, this coin is very volatile, right? It moves a lot, and the moves are very high. So I would not need to put a lot into it to actually make a good amount of money. So I wanted to buy some WIF over here, right? Well, it's already 50% up, where other higher market cap coins are not up as much. And the other way around as well, it went down like more than 60%. These are the numbers I use, so I'm literally just gonna put it here, right? These are the numbers I use, because I think they're good. But the general concept should stick for everyone, where you should use more, like a larger amount of your funds for higher market cap coins and less for smaller market cap coins. Especially this one is something a lot of people often forget, where micro caps, they can sound good, right? Because the risk to the reward is absolutely amazing, or like the potential reward is absolutely amazing, right? Because, for example, when say was really low, like right over here, you could consider it a micro cap, right? Well, look at that reward. Amazing. But it can do the exact same thing the opposite way as well. That is why it's so important. Because that risk to reward ratio, you need to calculate that into your spot gains. So that way you can keep your gains consistent. Just gonna get something to drink. I've had like a sore throat all day, which is like horrible timing. All right. So that's that for spot allocation, and then short-term spot. This is something I personally use a lot. Yeah, wish I had all this knowledge when I was starting. Yeah, that is exactly why I wanted to give this stream, because I got the question like I think 4 or 5 times in a row. And then when I actually gave the class, like because I gave it in one-on-ones twice, when I actually gave it, the reactions were really good. So I was like, well, you know what? I should give this class and just make a video out of it as well, so I can refer people to it. Because this is very core knowledge. Like, this is very fundamental knowledge. And it's also something that doesn't get talked about a lot. Because in the end, a lot of people are here into crypto to like make a profit, right? And you can't do that without a proper plan. So no matter what kind of plan you have, like even if you get different numbers than this in the end, right? No matter what kind of plan you have, you need to have a plan so that you can follow that. Then if it goes wrong, you can adapt and learn from it. And without a plan, you're just kind of doing stuff, and it either works out or it doesn't. And then you can't really learn from it. That is also why things like these matter for every style of TA and investing and whatever you do. Okay, now for short-term spot. Oh yeah, no, actually, before we go to short-term spot, there's one more important thing, which I rarely see noticed. Actually, it actually surprised me how little people talk about this. A very important thing is to always keep USDT on hand. I will literally always have 20% USDT on hand. Always, completely always. For the one simple reason, if the market completely flushes, if there's like a black swan event, or if the market goes down a lot in a very short amount of time, which can happen. It happens quite often. It literally happened a few days ago, right? You want to have USDT on hand to buy stuff. Because DCAing is a great way to make a profit. And these black swan events, or these massive drops, are by far the best moment to enter the market. Because just look at this, right? BTC in this moment went. It's like so nice that it happened a few days ago because I can just use a live example and everyone will still have this event in their minds. BTC went to like 49k, right? Which is ridiculous because we were at 70 a few days ago. Literally 7 days before that. 7 days before that, we were 42% higher. This is a major reason why I say you should always have USDT on hand. So if something like this happens and you see the market kind of cooling down, you can buy and you can DCA in. I know a lot of people did this, a lot of analysts did this as well. And I know a lot of people in chat said like, I don't have the funds to buy anymore. Which is very sad, right? Which is why I say you should always keep 20% on hand. So if something like this happens, you can buy, and once it goes up again, so let's say we start consolidating over here, right? We consolidate here for a few days. That's why you just take it out again. You could say, well, that's not a lot, but I think Pika did that like a few days ago, whereas average was like, yeah, I think Pika's here actually. So correct me if I'm wrong, Pika, but the average of his BTC spot was like somewhere around here, I think, somewhere in the 60s, and then we dropped a lot. So he DCA'd, right? He DCA'd around 50k, somewhere in this region, and he got his average up to like somewhere around here. And then once you're back up, you start consolidating, you can just take it out again. And if you drop again, you can DCA it again. That is why I recommend you to, like, everyone just keep USDT on hand no matter what. Because events like these are the fastest way to make a profit. And you want to make a profit, you don't want events like these to actually make you a loss. So that is it for the 20% USDT part. And it goes for altcoins as well, right? For example, when war broke out a few months ago, every altcoin dropped like 30% or something after the bounce, right? I think the lowest point was at like 50 to 60% low. And you just want to be able to buy that instead of having to sell or instead of not having anything on hand. Because events like those are the absolute best way to make a profit. I always use Injective for that example. I have too many charts active. I always use Injective for that as a good example because Injective at this time, say this is support, right? Very rough draw. Let's say you are someone that buys support resistance. Well, this is support. You wanted to buy that, right? Makes sense. I think in the end, this was not a good place to buy because market structure was bearish. But if you bought here, I would not find it too weird. It's like an okay place to buy. But let's say you buy here, and then you're like, oh, we just kind of dropped 44% in a day. Well, you are now literally at the next support level. If you don't have any USDT at this moment, you're going to be very sad because you can't buy. But if you do have USDT, then this is an absolutely perfect place to DCA it in. And that way you can lower your average by a significant amount. So your average can go from somewhere like this, from like 31-ish. And let's say you DCA, and even if you DCA with like half the size of your original entry, right? Your average is still gonna go like all the way over here. Your average, if you DCA over there, if you buy half the size, it's gonna be like somewhere over here, right? You would have still lowered your average by like 15%. So being able to have funds like that in case something happens, that you can just DCA it in and just kind of get yourself out of that spot, has a lot of worth. So that's why 20% USDT. And promise me, the next, like, you're gonna feel like sad the first time like the market starts going up and you're like, well, I still have this USDT on hand. But the first time you see like the market drop again and you actually have that USDT on hand, you're gonna be very grateful that you actually have that on hand and that you thought about it. Hey, yeah, what's up, Pika? And that is also something I wanna give away with that, with like talking about dips like that. Is one major reason, and I'm gonna go over that in a moment, but one major reason why people make, like, why the average person loses while trading, right? It is purely psychology. If the market goes up, you want to buy. If the market goes down, you want to sell, because you're gonna be like, oh wait, the market's going up, this is good, I want to buy this, I want to have more. And when the market goes down, you're gonna be like, oh wait, I was wrong, I want to get out. Don't use this. If the market is going up, you don't use this at all. You need to be able to consistently be profitable in trading, you need to kind of eliminate that psychological factor where you want to buy when it goes up and you want to sell where it goes down. You need to be able to make plans and just stick to that plan. That is a very, very important concept because everyone has struggled with that in the past. Like, psychology is an extremely hard thing to master. And I can assure you, even when I started, when I got a channel and I started as an analyst, right? Even then, I was like, well, I'm now calling in front of a bunch of people, and it just adds that psychological stress. Everyone has struggled with that. And that is the main reason, or one of the main reasons, why people actually make a loss in financial markets. It's because it's simply hard to eliminate that psychological factor. So, side note for that, by the way, I recommend anyone that struggles with that to switch away from red and green candles, because the colors really don't help you. If you really struggle psychologically with like buying and selling when it goes up and down, I recommend to switch. Like, the color doesn't actually matter, just don't have red and green, because we associate red and green with good and bad, right? And I don't want that. So that's why I personally use black and white, but any color scheme can work. Red and green is just kind of that thing that we associate with that. Yeah, any color can work. Just don't do that contrast. The contrast is really bad. Okay. Then finally, short-term spot. Short-term spot. What is very important about this is that you allocate a set amount to your short-term spot. So I personally use 15 to 20% now. I used to use 10%, I use 15 to 20% now, and I'm going to focus more on individual plays rather than having a lot. I'm going to use 10% in this class as an example because it's easier to calculate with. And 10% is something I use for a long time, so that's a completely realistic amount. So what I recommend for short-term spot is that every play you make follows this rule where you have one set amount, like percentage of your portfolio allocated to each spot play. So let's just say it like this. It's my text thing. I don't actually have it favorited. Let's say 10% per spot play. And that includes the ECAs. I'm gonna actually put that next to it. That is very important. If you make this allocation, including the ECA, so the entire play is gonna be 10%. And when I did that, I had a rule for myself where I had 6 positions max, so I would be 60% allocated max. If the market flushed, I had 40% left to buy. You can do 50% max as well, it doesn't matter that much. The idea is that you set this for yourself and a limit. So my limit was 6 max. 6 plays max. All of this is for the simple reason that this way you allow yourself to be wrong. Allowing yourself to be wrong is very important because the markets are not always going to let you have your right. And allowing yourself to be wrong and still make a profit is something very good to have. Because let's say you have this, right? And I'm just going to only use Bitcoin as an example here. For example, I longed Bitcoin twice over here, right? One went in profit, one didn't. Let's say after this, we go over here. And I'm gonna just tell myself, okay, wait, actually I have a chart for this. It's gonna be a lot easier. Yeah. Let's go like this, right? Let's say we reach this area. Or we reach this area first, right? I'm gonna buy over here. And I'm gonna DCA once. So I'm gonna have that 10% of my spot portfolio, my short-term spot portfolio. And this is gonna be my first entry. Like right over here is going to be my first entry. And then on this line, that is going to be my DCA, right? Okay, let's put the DCA. DCA. But well, what happened? Well, I went to sleep, right? And the market just nuked through. The spot position, I couldn't even stop loss it. Because my validation got triggered, I couldn't even stop loss it. If I use 10% of my short-term spot portfolio for this, I would have bought like 4% over here. I actually put that in as well, right? I would have used 4% of my short-term spot portfolio. And then 6%. So that way my average is going to be somewhere around this line. My average would be somewhere around here. Let's say I do that. And now it's all the way down here. Because I followed this plan, which we have right here, 10% per spot play, 6 play max, I will still have funds left to buy. And that way, when this happens, I can buy over here. I can buy it over here, and I can reduce my average by quite a bit. You can probably reduce, if you buy it at like 50k, you can probably reduce your average to somewhere over here, or somewhere over here. It is the same concept of why I said, always keep 20% for your long-term portfolio. Literally the same thing, but I'm for short-term. And for short-term, you want to be a bit more aggressive, so you kind of keep a bit more, so you can DCA heavier. Because these are the moments where you can make the most profit. What do you use to track all of your positions combined? Long-term, short-term, futures, etc., etc. Okay, I spend a lot of time trading, so I personally don't use portfolio trackers. For spot, and these are outdated. I don't have all of this anymore, right? I went completely out of the market right over here and bought Ondo and Aave back over here. As I signaled. So these are outdated, but for spot positions, I have a watch list. I literally just go on a watch list, right? And then I put my average, like I just put it on the chart. So this was our old average, right? We bought somewhere over here, that was the average we TP'd. That is what I do for spot. I just have a separate watch list with charts, and I just put my average on the chart. For leverage, I'm very active on leverage, so I am not someone who stays in leverage trades for, like, let's say a full month or something. So I only have a few open at a time, and I will also have a watch list for that. Also outdated, we're not on anything, but you can see how I allocate it, right? This is what I had, so this is how I keep track of that. Short-term spot, same story. So let's say I have a spot list like this, right? I would actually organize it like this. I would make an extra category somewhere over here, right? For, like, let's say long term. And I would just put a bunch of things in there, right? So I'll put BTC in there. I'll put all the, oh, they already are. I'll put like BTC in there, I would put Alno in there, Alve in there. That is how I keep track of it. Something else you can do is you can get like portfolio trackers. I don't have one I can recommend because I don't use them, but I know it can help for a lot of people. Will you post the stream later on YouTube? Yeah, everything is recorded. Everything is recorded, and I'll post the link in my channel and in the recordings channel. So that is how I keep track of it. And actually posting my calls and stuff as well really helps with that, because it keeps me accountable on having my stuff together. Okay, so 10% per spot play, 6 plays max. That is what I used to follow. What you actually do doesn't matter that much, but you need to make a plan like this. If you got heavier than 10%, let's say you go 20%, right? Because I have 15 to 20% right now. Let's say I have 20%, I will use 3 plays max. More allocation per play means less plays, because you want to have USDT on hand, and you want to not lose too much if you're wrong. Because let's say you were fully allocated during that altcoin dump from a while ago, right? Where altcoins dump like 50%. If you're fully allocated, you would literally lose 60% of your trading portfolio within a day. And you don't want that to happen. So that is why you need a percentage per spot play, and you need an amount of plays max, and you need to follow that. That is very important. Making a plan is the first step. Actually following it is the second, and that is hard. If the market is going up a lot, it is very easy to over allocate. It's like a psychological part. Over allocation is very easy if the market's going up really fast, and then you would just buy, be very heavily allocated, and then the market will just reality check you. Because that's the thing, if you don't humble yourself and put yourself into a spot where you allow yourself to be wrong, then the market will do that for you, and you will eventually learn it the hard way. So that's why you will probably need to tell yourself this a lot at the start, because it's very hard, but it is worth it to put in that extra effort to actually get yourself to do that, because otherwise the market will do it for you, and you really don't want that. And then something that not a lot of people talk about, every analyst will give you this answer if you ask them, but it is kind of a given for a lot of people. Your DCAs should always be equal or heavier than your original entry. So let's say you have 10% max, right? What I personally use for most spot positions is entry 1 will be like, will be 2%, right? Or 20% of the entire allocation. Then entry 2 will be 3%. And then entry 3, maybe 5%. The numbers you use, again, don't matter. 1.7 times heavier is a rule of thumb. What matters is equal or heavier. Never start with your heaviest orders. If you start with your heaviest orders, the DCAs will not matter that much, and what's it called, and you will not actually lower your entry by a significant amount. So there are two ways of doing this, and that is either you do it like this, and you DCA in single orders, or you kind of set a range for yourself. So let's say you want to buy Bitcoin, right? And you have your SR levels drawn out, and you say, okay, I want to buy in this box. Something else you can do is just like set a bunch of orders, like set like 10 to 20 orders and just buy and buy and buy, and you just gradually make them heavier. That is also possible. I don't do that personally, but that is a completely viable strategy. So either these in single orders or just layer like a bunch of orders in like a slightly larger area, so you just make sure your average is going to be good. But again, rule of thumb, equal or heavier on entries. And that is the very that is like a TLDR of how I manage my spot portfolio. So a quick summary: I have a long-term spot, which is divided like this. I have short-term spot, which is divided like this. I will always have USDT on hand. So 6 plays max with 10% also implies that you have 4 plays like kind of on hand, right? So I'll always have USDT on hand. And then, of course, my future portfolio. 90% spot, 10% futures. That is how I manage my spot. Are there any questions about that? Well, you guys are asking questions, I'm gonna get extra water. It's like because it's summer holiday, right? So I don't actually give class anymore right now. It's like my throat or like my voice is not used to it anymore. What amount of money do you recommend to start with for beginners? That is a good question. The actual amount of money, if you are truly beginning, right? Like you literally just decided yesterday, hey, I want to start trading crypto. The best thing to do is to start paper trading. And I'm going to go over that in a moment. But first I'm going to start with, I know a lot of people don't like paper trading. I personally don't like it either. I didn't paper trade at the start. But the best thing to do is to start with paper trading. For the single most important reason is that you will not be profitable at the start. You will make a loss one way or the other. It might start good because the market is going up, but you will eventually make a loss at the start, which is simply how it is, right? The market is made to make you lose. So what I recommend if you don't like paper trading is to allocate your portfolio exactly like this and then downscale everything to 10% of that. So set funds aside for your trading, and let's say you put 10k aside for trading, right? You put 10k aside for trading, you manage your portfolio like this, and then you should be paper trading at first. Don't get me wrong, you absolutely should start with paper trading, but a lot of people don't like that and just instantly want to trade with live money. If you don't want to paper trade with 10% of that. So if you put 10k aside, start with 1k. Or even less, right? Because you are actually trading to learn. You are not trading to make a profit at the start. Because it is unbelievably unlikely for you to actually make a profit at the start of trading. So either, if you're truly beginning, right, either start paper trading, which is my recommended, or start with a very small amount, like 10% or less. Also, just focus on spot first, yeah, and that as well. If you are just starting to trade, like, stay away from futures at the start or trade very small amounts. What platforms do people use to trade? I personally trade Blowfin on leverage. I have a ref code if you want, so you can get some cash back, because I have like a link that gets like 20% cash back on fees, which is really nice. I traded MaxC for a while. I think MaxC is fine. for scalp trading, but Maxi has a problem with stop losses where they don't trigger quite often. I would like to use Binance, but it is restricted in my country, and I don't want to go through the hassle of getting an ID and a VPN. I haven't used any other exchange. And for demo accounts, the most convenient demo account is in TradingView itself, but I highly recommend to not use that one for the simple reason that if you want to kind of disconnect from that psychological strain of trading, the one in TradingView is absolutely great, right? It works really well and works really easy. Bloating code, yeah, I'll get a bloating code. The one in TradingView works really well, but if you want to consistently trade and kind of move away from that psychological strain, it's called. I should actually have it somewhere. And I'm just trying to get that code in the meantime, yeah. Like that. Okay. If you're trying to get away from the psychological strain of trading, then you should get into a habit of being able to just make your trade on TradingView. Like you go on TradingView, you make your entire trade, you get your entries, you get your stop loss, you get your TPs, you do all of that. Then you go to your exchange, you put in the trade, and then you close your exchange again. If you do that, you consistently do that and get into the habit of doing that, it will greatly reduce like the amount of psychological stress you're under, because you will see it as your trade going right or wrong instead of you just seeing that P&L go up and down and up and down and just being like, hey, I'm gonna lose, or I'm gonna make money, I'm gonna lose. That is something that really helps a lot of people. So that is why I don't recommend paper trading in TradingView, because you're gonna get into a habit of also trading in TradingView. Because you can do that, right? You can connect your broker to TradingView and you can trade there. And I highly advise against that because it is just psychologically is a lot harder. And then something you can do if you trade on an exchange where you want to really make sure that you know when your stop loss triggers or where your TPs trigger, where it is, you literally just go and let's say you have a long like this, right? You have a long like this and you have a limit order. What you can do is you can literally just make this horizontal line like this. And if you click the line, this window will show up somewhere, right? This window where you can kind of edit it. You can just press add alert and just press create, and you now have an alert. And if price reaches that level, then I'm gonna get an alert, which you can do instead of just looking at your exchange. And then let's say price goes like this, right? And it taps your entry. You will get that alert, and you just go to your exchange. You can check like, hey, did it actually trigger, or did it front run me? Sometimes that happens, right? Where it front runs by like $1 or something, and you have to enter manually. So you can set alerts for that. So what do I recommend for paper trading? I don't know. I think most exchanges have it. I think VMAX has one. I think BingX has one. Bybit, Binance has one. Most exchanges have it. So I just recommend getting any kind of copy trading thing. I also recommend if you're gonna, well, copy trading, don't copy trade. Copy trading sucks. Paper trading. If you're gonna paper trade with a realistic amount of money. If you were to trade with 10k, then also paper trade with 10k to get used to those numbers. Because if you got to trade with 1 million while your portfolio is like 10k, then those numbers are not going to feel realistic. So you're not going to actually get into the habit of like taking it seriously and fully trying to make profit, right? Because if you're paper trading, you're doing it to practice and you're doing it to get better. So you need to take that serious and actually get better as if you're playing with real money. Which is also one of the reasons why people don't like paper tradings, because it's hard to take fake money seriously. But I do recommend starting like that. And if you can't, start with a very small amount, like downsize to like 10% or even less. So you can practice and you can get better at trading without actually losing money. Quick question. They also keep tokens and trade on chain. Do you believe there's an added value on chain? I don't get a lot of. I don't have a lot of coins on chain. I do have some of them on chain. Like I have a bunch of Say on chain because I got really early into Say, so I needed it on chain. And I had some meme coins on chain because it was simply easier to buy. In general, I don't hold a lot of coins on chain. I hold them either in my exchange or on a cold wallet. So like a ledger or anything similar, right? So for example, I have a good amount of Bitcoin and a good amount of ETH. I keep those in like a cold storage and I don't touch them. Like I literally just have a cold storage somewhere which I simply don't touch. Because if I have it in there, it's going to be very hard for me to sell, right? So I'm not going to sell it even if I'm like in a panic and the market's going to crash. Because it's not available. It's a lot harder. And having it in a cold wallet is also a lot safer. So I don't necessarily have a lot on chain. Yeah, it's like a vault, exactly. But I don't have anything against it either. Like I do trade on chain every now and then, and it's completely fine. But I just like the convenience of an exchange. I do memes on Solana. Yeah, I absolutely don't do that. Yeah, Moomoo was good though. I trade the ones that are on exchanges, right? I think you saw my Popcat chart at the start. I got into Popcat really early. Shared this on Twitter as well. And I got into Moomoo as well because someone talked me into it. Moomoo was really good because there was a guard here. But yeah, so I do trade on chain. Sometimes it's more convenient. It's actually just convenience. How much market cap or how long does it currently have to live for you to consider it a small cap or a micro cap? So it is actually market cap, and I categorize like I don't have a set number, but you can see it on the chart. So let's say you have a small like a micro cap. You probably have something in mind. Do you have a ticker in mind like a micro cap? Because in reality, I'm gonna be honest, I don't even have these. I don't trade micro caps at all. I have some shit coins, right? I have meme coins. I have like Whiff and Pepe, for example, and I have a bit of Mumu and Bobcat. But it's like I don't even. This category for me is meme coins instead. Meme coins are the best micro caps. Yeah, but meme coins also have a really big market cap sometimes. Like Shiba and Doge have like a ridiculous market cap. Also, by the way, because I didn't actually say that, large caps exclude Doge and Shiba, like those kind of meme coins. Those don't count on the large caps because there might be large caps, but they are not large caps in the same way that Ethereum is, or AVAX, or whatever, or Link. Completely different category. Large caps is market cap and a little bit of fundamentals. You just kind of exclude meme coins. Yeah, large caps, legit projects. Okay, that was it for spot, right? Yeah, legit projects. I'll be honest. In the end, there is only one real like legit project, right? If you truly think in long term, if you truly think in like 10 to 20 years, I genuinely think the only like safe-ish bet you have is Bitcoin. The others are probably bad. Even Solana, I don't think Solana is going to be at a good price in 5 years. I think Solana is going to be at like $10 in 5 years. Because Solana has a lot of scalability issues. And even recently, you're starting to see that because like the amount of time it takes for them to deal with the congestion issues and the bots and those kind of things. are, it doesn't matter right now, right? Because it will eventually get fixed. But the amount of time it's taking them is a very good sign of showing that Solana isn't that scalable. In the future, more problems like these will come up, and Solana will have a lot of trouble dealing with them. So in like 5 to 10 years, I don't think Solana's going to be a good project. I literally only think Bitcoin is. But anyway, moving on. Futures. Futures, I'm gonna... Yeah, ePlay 2s as well, right? In 10 years, I don't know what Arbitrum is gonna be. Arbitrum could be at 10 cents for all I know. Got no clue. Because the project isn't good enough to say that for certain. Like, Link makes a good shot, for example. I think Link is fundamentally a very good project. Link in 10 years is probably still at a decent price. XRP probably still at 50 cents. I don't think that coin moves. But anyway, futures. Let's go on stream. Futures has two ways of trading. I'm going to go on a separate tab for this. I'm going to go on ETH. Because quite frankly, I usually trade altcoins for futures, right? I'm on the right layout, right? Yeah. So let's do the same thing for futures. Actually, I'll screenshot this first, put it in chat. Put it in chat, like that. What's this? Oh yeah, this was exactly what I just explained. Okay. Futures. How do I trade futures? There are two ways to do so. Or like two main ways. There are more, right? If you have a good system that might work, there are two main ways. Two main systems. You have futures trading number one, which is leverage spot. Which is where you go on like very low leverage and then trade with very big margin and you just trade it like spot. Option two, risk to reward systems. This is my preferred way of leverage trading, and I'll go over that in a moment. What are the characteristics of this? How do you trade leverage spot? Leverage spot is exactly what the name implies, right? You would go on very low leverage, like 3x to 5x, something like that. That is about the max you get. And then for like Bitcoin, you go on like 10x. Maybe you usually go a bit higher for Bitcoin because it moves a bit less than altcoins, right? But in general, you go on very low leverage. If you go on meme coins, you go even lower. You go 2 to 3x max. If you go... Wait, my mouse is dying. If you go on, for example, Bitcoin, you go a bit higher. It depends on the coin you're trading. But in general, you're going to do about 3 to 5%. Trades like spot. That also means you can go a bit higher in risk. For leverage, like for this kind of leverage trading, you can go to like 5 to 10% of your margin per trade. Where let's say you have a Bitcoin trade, right, and you want to risk 1K on that trade, you can just take a trade. You will put 1K margin into your exchange, right? Your margin is going to be 1K, and then you just slide the leverage bar up to like 5x, 10x, something like that. You will stay on low leverage, 5x max, except for Bitcoin, and then you trade that 1K margin exactly like spot. And your validation with this style of trading is also usually going to be a soft stop loss, just like you would have on spot. Because on spot, you don't usually actually set a stop loss, right? You set invalidations, and if that invalidation happens, then you close. I'm getting a lot of DMs by support team. No, they are just talking about charts. There's nothing actually happening. Okay. Because with spot, for example, let's say you buy over here, right? Because it's support, supposedly. The support over here. You're not going to actually put a stop loss below support, right, for spot. What you're going to do is if it drops below and then retests, they're going to sell over here. Because you're going to sell on the retest for spot. Which is like standard market structure, right? I'm going to go over that in a moment. Well, actually, I will probably do the core TA concepts a bit later because stream is running late, right? But I'm gonna go over leverage first. So that is how you trade spot, right? You don't actually put a stop loss, you put in validations. And then once that validation happens, that's when you close. That's when you cut your position and loss. So for example, you could argue that ETH is doing that right now, right? Let's say we consider this as resistance. Well, because we rejected off of it here, and I used it as support over here. So you can make a good argument that this is resistance, right? Would make sense. If you would be in an ETH spot position right now, it would make very good sense to sell here. Because the logical step would be to reject and make a lower low. If we reject here, that is the most logical next step. That's completely outside of my bias, right? I obviously have a bias on ETH, but completely outside of that. And that is your invalidational spot. You don't use a hard stop. If you have a hard stop, for example, you would likely put it somewhere over here, and your stop loss would have already been triggered. That is a different the difference between how most people trade leverage and how people trade spot, right? Hard stops, soft stops. That is the main difference between them. Low leverage trades exactly like spot. You are literally trading spot, but on leverage. And one thing to keep in mind is if you hold for a really long time, is that you're gonna have to pay funding fees. Because what you're doing with leverage is you are buying contracts, and those contracts have like a price and whatever imbued into them, right? But you need to pay your exchange a bit of a fee, like every 4 or 8 hours to be able to hold those contracts. Usually, if funding rates are positive, then longers have to pay fees to the shorters. If they are negative, shorters have to pay fees to the longers. So, for example, while the market was going up like this, if you are shorting, well, one, I don't know why you are, because you're making a lot of loss, but at least you're getting paid funding fees because you're holding a short position, right? At least that's nice. You're gonna be going like 100% in the wrong direction, but at least you're getting funding fees. Look at it on the right side. A lot of coins actually have that, right? For example, right now, EYDX, which I shared earlier today, the EYDX has negative funding rates. So longers get paid to hold their positions, and shorters have to pay to hold their positions. That usually only matters if you're holding for a very long time. You can actually trade these. For example, everyone that trades funding fees long this thing, because the funding fees were like at -3%, which is ridiculous. So people started buying this because there were so many shorts, and they just liquidated all the shorts. This is called a short squeeze. That's also what happened with GME. I think a lot of people know this one. Good example. This is called a short squeeze, where so many people shorted that the funding rates are so high, in crypto at least. It works a bit different in stocks, but if funding rates are extreme, this can happen. It works different in stocks, but kind of the same concept. If you hold your long for a very long time, you have to keep in mind that you're paying funding fees. You don't pay funding fees in spot. That is a very important difference. So if you are truly holding something for long term, don't trade leverage spot, just trade spot. Makes more sense because you don't pay the fees. If you trade this system, margin is gonna be your hard stop. Oh, and one more thing, you're gonna be trading on isolated. I'm gonna go over that one first. You have two types of margins. You have isolated margin when trading leverage, and you have cross margin. These are very different. When you're trading isolated, what you're gonna do is you're gonna put a margin into your position, right? Let's say you put 1k into position at 10x leverage, so your position is gonna be 10k. The margin you put in is gonna be 1k. If you trade isolated, the absolute maximum you can lose is at 1k. You cannot go beyond that because it's isolated margin. That is your position. You will not lose more than that. Trading cross takes your entire account into consideration. And that might sound more risky because let's say you don't have a stop loss, right? And it goes down a lot. You might get your account liquidated. To some extent, yes, that is true. That does sound more risky. But the reality is that with isolated margin, setting your stop loss is a lot more tricky because your stop loss is going to be based on your margin. Your margin is your stop loss. Once your margin runs out, that is your stop loss. That is the main reason why I don't like trading isolated. I want to put my stop loss based on TA and not based on my margin. And you could argue, yeah, but just put in more margin, like put in more margin or lower your leverage and then put a hard stop. That is true to some extent. I dislike that personally. I know a lot of people do like trading this way. I personally don't. So what I'm gonna do is I'm gonna say that is how it is, and if you want to trade that way, completely fine. Know that your margin is your hard stop, and then what you're gonna do is you're gonna, what I just explained on ETH, right? You're also gonna have an invalidation just like you would on spot, where if market trend shifts bearish, you're gonna sell on a higher low or what's called a lower high. If you want a more in-depth explanation of this, I know some people trade this way, right? For example, Sherlock trades like this, Caleb trades like this. I don't trade it, so that is all I can tell about it. Because I only want to say things I'm 100% certain about, right? Then my preferred way of trading leverage is risk to reward systems with cross leverage. Oh, yeah. One more thing, because you're trading spot, it's kind of obvious, so I'm not gonna explain it too much. Your wins and losses are gonna be based on percentage as well. So win/loss is gonna be based on percentage. If you gain 10%, then you're playing 3x, so you're gonna gain 30% of your margin. If you gain 10% and you're playing 5x, you're gonna gain 50% of your margin. Kind of obvious, but that is that's the difference as well. Then the way I trade leverage and the way I recommend people to trade leverage is cross margin risk to reward systems. What is a risk to reward system? A few things to know about it. Leverage does not matter. What you're gonna do when you trade a risk to reward system is you are gonna make an entire system based on R. R is risk and R is reward. Let's say you have 100% of your leverage portfolio, right? So that equates to like 10% of your total portfolio, as we discussed earlier. Out of that 100%, I'll actually fully, because this is maybe the most important part about risk to reward system, so I'll actually fully explain this. I'm going to write it as 100%. Just know that 100% means 10%, because it was 90% spot, 10% leverage, right? 100% forward. How you divide that is you're going to make 1R. And your 1R, what that is going to be, is that is going to be 2% of your total portfolio. Give me 1 second. All right. 1R. I recommend everyone to start with 2% as 1R. So what we're going to do is we're going to take that 100%. 2% of that equals 1R. So if you have a 1K portfolio, that is going to be 20 bucks. If you have a 10K portfolio, that is going to be 200 bucks. 2% is 1R. What is 1R? If you have a position, you have a long position like this, 1R is going to be the amount you lose when your stop loss hits. R equals loss when SL hits. And the most important part about risk reward systems here is knowing how you do that. So let's say I have a 1K portfolio, right? Trade with 2%, 1R. If I make a trade, let's say I make this trade, right? This exact trade, and I'm a donut and I didn't take profit, right? It is what it is. I just round trip 5R. It happens. So let's look at it like this, right? This goes down 5%. And I made this trade in a risk reward system and I went in with 1R risk. How much do I actually lose when the stop loss hits? $20. Yeah, exactly. That's what it is. Exact same setup. But now I have the same loss. I went into this with 1R and it dropped 26%. How much do I lose when my stop loss hits? %26 times that. That is the main difference between spot-based systems and or like the leverage spot, which I explained earlier, and just reward systems. Even if this happens, I will lose 1R. The leverage in this case doesn't matter. The percentage it moves does not matter. No matter if it loses, if it like drops 26%, or even if it drops like 1%, right? The most important part about a risk reward based system is adjusting your size, like your position size, to the point where you will always lose 1R when your stop loss hits, no matter if it's 2% or if it's 20%. So what you would do on your exchange is you can go on the exchange, right? And if you trade a risk reward based system, you are on cross margin because, for example, play like this is not really playable on isolate, right? Because you're gonna play at like 67% leverage. Doesn't make sense. You would need to calculate for every single play again and again and again. And then exchanges also have some things in place that make it a lot harder. I've tried trading like this, it doesn't work. You need to play across. But what you're gonna do when you trade this system is you're gonna go in your exchange, you're gonna put your entry, you're gonna put your stop loss, and then you're gonna adjust the position size until that little minus P&L bar, like below your stop loss, says minus, in the case of our like the portfolio of 1K, minus $20. And that means that a position like this, you will be able to have a lot bigger position size than a position like this. But no matter which position out of these you take, by adjusting your position size, you will make sure that you will always lose 1R. You will always lose $20 with that portfolio, right? That is the most important thing in a risk reward system. The percentages don't actually matter because when you enter a trade, you will adjust your position size so that your stop loss will always lose the same amount. And it goes the other way around as well, right? Risk to reward ratio. Always 1-to-1 R. Wait, what? What do you mean by that? What do you mean with 1-to-1 RR? You suggest the trade should always be one risk reward. No. So for the trades you take, 3 is like a baseline, right? You should have around a 3 risk to reward potential in your trade. But the very important part about this is that your stop loss should be 1R. You calculate your R beforehand. No, don't be sorry. It's good that you're asking questions. Completely fine. So you calculate your R beforehand on that 1K portfolio. That would be $20, right? You calculate that R, and then when you put it into your exchange, you're going to put the entry, you're going to put the stop loss, and then you're going to change your position size to make sure your stop loss will lose you that 1R and not a different number. Because otherwise, if you're going to have, if you're going to take like 5 trades and you're going to go in with a different stop loss on all of them, you're going to maybe lose 20, lose 50, lose 20, and then you're going to make 50, and then you're going to make 10. And then just kind of, because you're playing with different sizes, and it kind of brings that extra inconsistency that you don't want. To become, like, to consistently be profitable, you need to make sure your trading is as consistent as possible. So in this case, you will keep your R the same for an extended period of time. You calculate that R once, and everyone uses different things for this, right? You can say like, okay, I calculate my R at the start of a month. Every month, I'm going to go to my portfolio, take 2% of that, and that is going to be my 1R for the rest of the month. Or you can take it by milestones, right? So let's say you trade a 1K portfolio, and you build it up to like 1,500, and then you recalculate it. One important thing to note is that you should not change it with every trade. There's a very long mathematical reason behind that. Long story short, if you change your R with every trade, your newest, most recent trade is going to be the most impactful, and you don't want that. So if you win 3 in a row and you keep sizing up, then you will have your most size when you lose eventually, because you are eventually going to lose, right? And you don't want that to have a bigger impact than your wins. Same way the other way around. You lose, and you downscale, and then now you have like a very low scale compared to your losses on your next win, potentially. You don't want that. So keep it at either like every month, or keep it at every like 50% of your portfolio, for example, or 20%. Doesn't matter. Set milestones, and that's when you recalculate it. Yes, everything is recorded. So I know I'm going over it a bit fast. You can just watch it back later and just ask me any questions in chat. That's it also, by the way, that if you start implementing any of this into your trading, you come back at it at a later moment and you come up with questions, just go in chat and just tag me, and I'll try and see if I have a good answer for it. It's too much information and precious information. That is good to hear. That is really good to hear. I'm glad it's helping you out. Usually think of why trade, where to P, and usually calculate stop loss based on that. I have difficulty defining a proper stop loss. Yeah, what you're doing is good, really good. That is exactly how you should trade, right? And that is why I prefer risk to reward systems. That is the next thing I wanted to go over. Risk to reward systems, why they have my main preference over others, is because you are able to do that. You can go onto a trade, and let's say you think this is resistance, right? This is resistance, and this is your last support. You can just say like, okay, I'm going to put my stop loss below support, and I'm going to put my TPs at resistance. And no matter where your stop loss is, no matter where your TPs and your entry is, you will always be able to take that trade, because it does not matter where your stop loss is. You will always lose 1R no matter what. If it's down here, or if it's all the way down there, you will always lose 1R no matter what. So you just put it at the place that invalidates your trade. Difficulty defining a proper stop loss. There are a lot of ways to do that. I'm going to give you a quick answer right now for the simple reason that I want to go over a few more things before the stream ends, right? I can help you later or next week, because I'm gonna give like an extra class on this next week, but more technical analysis wise. So like the very core concepts of technical analysis. So not any very difficult things like harmonics, but very core concept like time frame alignment, market structure. I'm gonna go very in depth on those two, because those are very important to every style of trading, no matter what you trade. Quick answer though is that you want to mark out, for example, if you're gonna long, right, you want to mark out support. So let's say you see this box, right, and this box over here, this box has a lot of wicks, right? So price went in there and then didn't accept in that area, and it went out again. So we can see, okay, that is support. So you're gonna draw that support out, and this blue box is my support, right? I'm someone who draws support in areas rather than single lines. So let's say that is support, and I would enter at the top of that support, and my stop loss would be a bit below that support. So for example, there's a wick over here, right? There's a wick right over there, and I would put my stop loss like slightly below that wick, something like that. And where do I TP? I TP at resistance. So we have a significant high over here. I don't know where to say. We have significant high over here, and we have significant high over here. That is where I would take profits. That is very basic, right? That is how you take profits, stop loss, entry points on a support resistance based system, which I think is what most people trade. So that's the like the example I'm giving. For Fibonacci systems, you would pull a fib, and you would take profit at the 0.382, so right over here. At the 0.618, so right over here, and potentially the 0.214 right over here, and then a 0.786. But that is more TA based, right? It depends on what system you trade. In general, stop loss below resistance, you give yourself a little bit of room, and TPs at resistance, or below support and at resistance. Okay, so that is the main reason why I prefer risk to reward systems, is for this simple reason. If I make a play like this, I can chart this entire play out in TradingView. In TradingView. Yeah, no problem. Don't worry about it. Which Fibonacci class here? Yeah, thank you. I'm really glad people people are liking these classes. I've been getting a lot of good reactions on them, so really, it's really good seeing that it actually helps a lot of people. It's really nice. Okay, so the main reason why I prefer risk to reward systems is for this reason. I can go on TradingView, I can make this entire play, right? I can chart it out, set my entry point, my stop loss, and my TPs. And the only thing I need to do is I go onto my exchange, put in my entry point, my stop loss, then my position size. Keep in mind, I'm playing a risk to reward based system, so my risk to reward will always be 2% of my portfolio, or 1R. That 2% is calculated beforehand, so my risk will always be 1R. I adjust my position size so that my stop loss will be minus 1R. In the case of 1K portfolio, that would be $20. I adjust my position size to lose $20 when that hits. Then I put in my TP, any TPs I have, and I leave the exchange again. That is it. That is why I prefer it, because I can do everything beforehand. I don't need to think about leverage. I don't need to think about position sizing based on my spot. I don't need to think about any kind of heavy allocation, lighter allocation, any of that. Always 1R. I will always lose 1R if it hits, and my TA will always be my TA. This is where my stop loss hits. If it hits, it hits. It doesn't matter. It is 2% of my leverage portfolio. It doesn't matter if it hits. What matters is that over a long period of time, I will eventually be profitable. Yeah, accepting a loss, because that is important. It is extremely important to make losses, allow yourself to make those losses, and then just move on. Because sometimes your setup can be absolutely fantastic and it will still hit stop loss. It happens. And if your system, like if you're trading like this, exactly what I just explained, make the trade, put it into your exchange, and then just play the trade exactly how you planned it, right? What if $20 doesn't get you below that wick? That cannot happen. It absolutely cannot. If you're trading a risk-reward based system, you're trading on cross margin, right? One. You are usually trading on maximum leverage because leverage does not matter in this system. That is very important to understand. Leverage does not matter because what you're doing is you're trading cross and your stop loss will be -1R. So if you go into your exchange and you put in your entry, you put in your stop loss, you are on cross margin, very important. You will adjust your position size to make sure that this stop loss is -$20. -1R. So in reality, what that's going to be on this position, that's like 6%, right? 6%. So 6% loss. I gotta pull up my calculator for this one. Wait, actually, I have a challenge account active. Actually, I can just do it on my challenge account. We're doing like a 100 to 1,000 with a bunch of support team members. Just do it like that. So if I go on Ethereum, I don't think you can actually see this, right? I will I'll actually change screen share for a second. It's actually sharing it. You can see it now, right? My challenge is not going good, by the way. I'm down $6. It is what it is. Okay. You can see it, right? You can see the exchange, everyone? Yes, okay. I don't know if it's actually visible on the recording. It is not. Can I change that real quick? Yeah, okay. Give me 1 second. I'm changing it in the recording. Yeah, okay. It's visible on the recording as well now. So I'm gonna pretend I'm trading this $100 account, right? I'm gonna go on Ethereum and I'm gonna put in the exact play that we just made right over here. So let's go on this. I am on Ethereum. Limit. What is our entry? Our entry is 28.91. I'm doing a long. The stop loss is 27.18. Leverage, it's on 200x, doesn't matter. It could be a 10x as well. It really doesn't matter. I'll show you why later. Okay, if you're trading these kinds of sizes, like actually getting to $2 is probably not possible. So I'm gonna pretend that we're doing $20, right? I'm gonna pretend this is 1K. So let's go on that. We want a stop loss of -$20. What if I do 1,000? That's like $60. So what if I do 300? Well, almost there. Yeah, so it's about, yeah, it's like 350. I just adjust the size so that this number down here goes to -20. So if I'm on 300, the number says -17, right? If I'm on 350, it says -20. This is what I want. And because I'm on cross, this will always be allowed no matter what. Because you're just trading a completely different system, right? On isolated, this simply doesn't work. Because exactly what you said, that -$20 will not get you there. Your actual margin will run out like right over here already. So it won't actually get you there. When we play with DCs, we have to some... Yeah, really good question, actually. I'm going to show why leverage doesn't matter first, and I'm going to do that. That is a very good question. So what happens with this exact play, right? -$20, 200x. Let's say I reduce the leverage to 15x. What changes? Nothing. Still -20. Put it back to like 136. Still $20. Doesn't matter. If you trade this system, leverage truly doesn't matter. Because no matter what happens, it will always be that $20. And that is also one of the reasons why I prefer it, because it just makes trading less complicated. And this is like a system that a lot of people actually use, but a system that that not a lot of people talk about. I don't understand. What do you not understand? Why changing the leverage does not change? Okay, so kind of like this, right? What leverage does is leverage takes your margin into account, gets that margin. So let's say you have $1 margin, and then that $1 on 200x leverage is gonna be a $200 position, right? Your margin is $1. That is what the leverage is going on. And if you are trading an isolated system where your margin is your stop loss, then trading on 200x will be a $1 stop loss, but it will be really fast because the price will only have to move like a fraction of a percentage to actually lose you $1. But in this case, where's our margin? Our margin is $2, but we are on cross. So our exchange is taking our entire portfolio into account. So if I don't put a stop loss, this is the maximum risk, right? Because it's taking the entire leverage portfolio into account. You need to be aware of that. You need to always have a stop loss while doing this. If you trade soft stop losses, I'd recommend staying away from that until you are very experienced, because it's possible, right? But you need a lot of experience for it. You need to know exactly what you're doing. So for now, only use hard stops because it's simply a lot safer. Are there times where it goes too fast for the stop loss to hit? On some exchanges, yes. Maxi does that every now and then. If something like war breaks out and the market absolutely nukes, it might trigger the stop loss lower, or it might even not trigger. So if you are trading very like tight margins, right? You are trading a position like this. Let's actually put this into the exchange, right? Entry 2890 and stop loss 2877. Let's say you're trading that, right? 2891 and then 2877. If you want to get to that $20, you need to go to 4K position size. If you're trading these sizes, like stop loss is that tight, you need to really be careful with what's it called, with like how long your trade is going to take. Your trades won't take that long if you're playing these sizes, because you're, look at that, right? Your stop loss will either hit really fast or you will get to a point where you want to take profits really fast. Because keep in mind, if your stop loss is an RR based system, then so is your profit, right? Let's take this exact position into account. So we have this, right? Well, stop loss is 1R, right? But that also means that we only need to move a very small amount to hit like 2 RTP. So it works two ways. If you're trading a position like this big of a position, you want to also you want to make sure that you don't make a trade like this and then immediately go off. If you make a trade with that tight of a stop loss, that is a scalp trade, and you want to like kind of be around for the trade. You don't have to be on your desktop all of the time. You can just like set an alert, right? And when that alert goes off, you just go back to your exchange and make sure that the stop loss actually triggered. Because you're playing with such a size that like it's a 4K position size, right, on an imaginary 1K account. That can go pretty fast if you don't actually have a stop loss. Any chance one day you can do a live trade and we can copy you on a future trade with a small amount, like $50 to $100, so we can all learn and practice and set up a few scenarios and trade? I mean, that is possible if the trades are actually there, right? But it's very hard to time trades. So, for example, scalp trades, I scalp trades very low time frames, right? So if you would have a setup right now, I would show you, but there is none. So yeah, I would be open to that, but it's like it is very hard to time. Because for that, there needs to be a setup. Where are you Maxi and Blowfin? This is a challenge account. I'm doing a 100 to 1k with a bunch of support team members. For scalp trading, Maxi is a bit better because of the fees. Maxi has really, really low fees, like lower than any exchange. As far as I know, at least. There might be an exception, but my main exchange is on Blowfin, yeah. Because Blowfin is really good with stop losses. That is the main reason why I trade there. For example, when the ETH ETF news came out, on the daily chart, right? Yeah. When the ETF news came out right over here, I had a head short active, right? Because I was in the long and I had this short active. So when this news came out, it instantly triggered and then just wicked through. I can give a class on hedges as well someday. Just know that hedges are there to protect you against one side. If I have 5 longs open, I will open a short to reduce my exposure. But anyway, I had the short open and it kind of just triggered. And that gave me a lot of faith in the exchange because that, like, Blowfin just triggers the stop losses, which is something I really want. And I don't mind paying a bit of extra fees compared to Maxi to be able to have that security. Do you trade indices and Forex at all? I don't trade them. I do chart them every now and then. So I have charts on them, but I don't actually trade them. I trade crypto and I invest in stocks. But I will trade Forex in the future because I like trading Forex. And don't worry about the questions. Like, really, a lot of people are gonna have the same questions and don't ask them. So I really like that you are asking them. Yeah, exactly. I mean, I charted SPY, right? I said when this happened, I said like SPY is gonna probably drop on this 1618, which it did, and I used this as confluence for crypto. Okay. We actually had a really good question. Do you guys understand this this system? Just expose myself as a league player. It is what it is. Okay. Do you guys understand this system? Have you ever liquidated an account? Yes, I have. Most traders have, actually. I can. I don't know. I'm gonna say everyone. It's probably not everyone. There probably are exceptions, but I can assure you that at least most of the analysts here have liquidated like one account. I know Cient has, for example. He's open about that, right? He liquidated an account like somewhere, I think, in the second bear market or in the first, and that is one of the main reasons why he started publicly trading, because he wanted to help people prevent themselves from getting liquidated, right? That is one of the main reasons I share it as well, because I got liquidated and it sucks, like it really does, and I learned how to not get liquidated, so I want to help people do the same. So yeah, I've liquidated one account because I was really overexposed, and I just saw, like, I just woke up to an account at like 0, and I went on the exchange and prices were higher than when I went to sleep, and that made me really sad because I would have been in a lot of profit if I didn't. That is also the moment I realized, wait, this spot trading thing is like really good. Do you guys understand this risk reward based system and why the leverage does not actually matter? Like when I change the leverage, why the stop loss doesn't change and those kind of things? Can't really wrap my head around it. Okay, do you have any specific questions or is it like a general concept? Yeah, that's what I was about to suggest as well. If you have a specific question, just ask it. If you come up with a specific question, like next week or something, just ask it. It doesn't matter. Just tag me in chat and I will answer it. If it's like a general concept, I recommend just doing it a few times. Like, you don't have to actually take the trades, right? But just go in your exchange and click the buttons. And try truly understand why. Because understanding how things work is a very important thing in actually getting better at it. Because you need to know what you're doing. You need to not be just putting random numbers into the exchange. You need to know exactly what you're doing. Because that is how you get better at it, right? You need to know what you're doing and have a plan to be able to learn. So, for example, I took a stop loss on BTC last night, right? Because I shorted it and it went above my stop loss. And I'm trading a risk reward based system, so I lost only 2% of my leverage portfolio because that is 1R, right? So one good trade will make more than that back. It's very risk managed. I can even if I don't actually have any trades open right now, right? But even if I would have like 5 positions open, that is actually something I forgot to tell. I'll go over that. But if I have like 5 positions open, everything hits stop loss. That is minus 10% on my leverage portfolio. Because my spot is separate, my leverage is separate, and I lose 2% per trade. It is a very safe way of trading. So I can also just leave for a longer amount of time without any worries, because everything is risk managed. If everything goes down and everything goes like completely in the opposite direction of what I think, I will still be completely fine. Because that is in the end the only way you can consistently become profitable, is by making sure that even if you're wrong, nothing actually goes wrong. Yeah, exactly. If you are looking at your trades every few minutes, you are either very overpositioned, very unsure of what you're doing, or just addicted to the charts. One of those 3 things. I have these days where I'm also just addicted to the charts and I just wanna trade and chart and scalp trade and whatever that happens. But in general, I can just you should be able to just walk away from your trades, just go to sleep, whatever, and just live your normal life without being worried. And most of the time when people can't do that, it's because they're like very overpositioned or something. Well, loving scalping isn't actually a problem, right? If you actually enjoy it and you do it like in a healthy manner. Because in the end, something a lot of people don't talk about either is that for you to actually be consistently profitable, you need to live a consistent life as well. If you live a healthy life, if you keep like your brain healthy by just eating proper food, just exercising every now and then, you don't need to be really healthy, right? You don't need to be like this kind of athlete, because I'm not either, right? I go to the gym like once or twice a week. Like I'm not an athlete, but it's like you want to stay healthy to some degree. You want to sleep well, consistent hours, and you want to eat properly. You want to go outside every now and then, even if you scalp trade all day, because all of those things will literally make you a better trader. Because you will be better at trading, you will be better at thinking, literally. Because being healthy just makes your mind think better. I don't know how to explain it, right? I'm not a neuroscientist, but you will notice that when you like don't sleep for a while or something, you're gonna not think properly. Yeah, if I have 4K on 10x, I need to have at least 40K on a cross account. You do not. Wait, my headset is running out of battery. 1 second. So let's go over here, right? I have $100 on this account. I'll see. 4K on 10x, do I need to have at least 40K? No. So that is what leverage is for. It's for being able to take those kinds of trades. So I have $100 on this account, and if I open a position worth $40,000, okay, I can't make a trade that big. If I open a position for like 4K, which is 40 times my portfolio on this account, right? I can still open that. If I open this right now, it will open, right? If I actually click the button, I will break the challenge, by the way. Part of the challenge is only trading BTC. So I don't actually care for losing like the fees, because it's like 50 cents in fees. But I can't break the challenge. So you can do that. You can do that on 10x's. I mean, 10x is a bit trickier. So the rule for this is that your margin needs to be available in your portfolio. So if you have 4K, I mean, if you're trading a 4K position size on 10x, your like trade will use $400 as margin. That is not actually going to be your stop loss, right? But that is the margin you have to put in. Which is why when I say leverage doesn't matter, I mean leverage doesn't matter for your position size. But the higher your leverage, the lower the margin that gets used. So technically, higher leverage is actually better for this system. Because if I, let's say I'm gonna actually put it into a live trade, right? See, I go on this. I'm just gonna take the same trade again. Let's take this trade, right? We're gonna enter at 28.91. 28.91. And our stop loss is gonna be 27.20 or 27.18. 27.18. Cross margin doesn't actually mean you need a second account, right? It doesn't. But because there's always a slight risk of actually losing more than you put in, I do recommend putting not all of your actual USDT in that account. So, for example, on my Blowfin, right, I have 10% of my portfolio allocated to leverage. I will actually only have like 20% of that 10%, so 2% total. I'll have 20% of that allocation actually in the live account, and the other 80% is just sitting in the funding wallet. And if for some reason I lose the 20%, I would just add a bit back. Because let's say the absolute worst happens, and I go to sleep and war breaks out, and the market absolutely nukes and my stop loss doesn't trigger. It's like kind of an extra risk management system where I just don't have everything that I have allocated to leverage actually in that account, just in case it goes wrong. Because you don't want it to go wrong. It's that simple. So I just have it in my funding account instead. I think Maxi only has like spot for this. So Maxi only has like futures and spot. So in this case, let's say I have 1K allocated to leverage here. I would have $200 on this. And I would put the other $800 in my spot wallet. So that's why I like it. I don't actually trade Maxi obviously, so I can't properly show it. But that is what I would do on a 1K port account. So I would have like about 20% in the actual live account on the actual futures wallet, and then 800 on a, what do you call it, on a funding wallet or a spot wallet or whatever, just in USDT sitting around. No, cross margin does not mean it can take from the spot wallet. That's very important. Cross margin can only take from the futures wallet. There are some exchanges that have it that you can play like, I think the name for that is called margin leverage or whatever. There are some specific exchanges that have a type of leverage that does that. So you really need to check that beforehand. Because you don't want that. You want to be able to separate it. I think Bybit has that. Bybit has an option to do that. I advise strongly against that. Your cross margins should absolutely not take your spot wallet into account. That is very bad. Blowfit doesn't do that. I'm 100% sure of that. Maxi doesn't either. I think Bybit has an option to do that. Binance probably has an option to do that as well. If you trade this system, please disable that option. Don't do it. I don't use either of those exchanges, so I don't have an answer to that. So what do we check to make sure it doesn't do that? I don't have the answer to that. You would need to check on your exchange. You can find it on like where you go to your leverage portfolio, like the home page. You can find it somewhere over there. But I don't have a good answer to that. But that way I also separate like that, right? 20% in the actual live wallet and 80% just right there in the funding wallet. Okay, then probably the last system. Or last first. Oh yeah. Last thing. With 2%, I will have 5 trades max. Or actually, I'm gonna rephrase it. I will have 4 trades in one direction max. Four trades in the same direction. If I have 4 trades, I will very likely have a trade open in the opposite direction already. But that is the absolute max. And what do I mean with opposite direction? If my bias is long, and I'm longing all of these altcoins, right? I'm longing Aave, I'm longing Injective, I'm longing TIA, I'm longing STX. 4 longs. Because I'm very, very positive the market will go up. I'm like extremely certain about it. If I have 4 longs open, I will go on Bitcoin, I will open a short. And I don't care that I think the market will actually go up, I will go on Bitcoin and open a short. For the simple reason that if I am wrong, that short is going to go in profit. If I am right, the short might hit stop loss, but all 4 of those longs will hit their TPs. Should make up for more than a stop loss. That is called hedging. It is a subject entirely on its own, but know that this 4 trades max, I will likely have a trade just in the opposite direction, just to have a trade in the opposite direction. Not because I actually think the market's going to go down. So I will literally just go on Bitcoin. Oh, it's the same over here, right? And I think the market's going to go up. Actually, let's go to CMB. I will actually just go on Bitcoin. And I will just go to CMP. Go to the next resistance, put my stop loss there, and I will just open it. And for the simple reason that if I have 4 longs open, then I have 1 short on Bitcoin. If I am wrong, well, the short's gonna hit TPs, right? That will protect me again. What's it called? If I'm wrong on the market, then this short is gonna hit TPs. It's gonna probably hit this TP, right? It's gonna hit TP for 2R, and that will make up for 2 stop losses on those 4 longs. If I am right and the market actually goes up, then those 4 longs are gonna print. I can make an entire class on hedging. That is a very basic concept of it. 4 trades max in the same direction includes that. I do not go over 5 even if I'm hedged. For the simple reason that you should not have too many trades open at the same time in case something happens. Then, for the question I got asked earlier, how do you do DCAs with this? This includes DCA. 2% more includes DCA. So if I have a trade like this, let's say I want to enter here, and I want a DCA over here, right? Then what I'm gonna do is I have that 1R, right? 1K portfolio, 2%, 20 bucks. I'm gonna keep repeating it because it's important to realize. 1K portfolio, so 2% of that, 20 bucks. I have 20 bucks I can allocate to this trade. This 100% includes DCAs. So we stick to the rule, equal or heavier on DCAs. For this example, I'm going to go heavier on DCAs, right? So with that 2%, I would enter for a 1%, for $8 stop loss over here, $12 stop loss over here. I just go slightly heavier, right? It's like the rule of thumb is like 1.7 times heavier. In reality, no one's gonna actually do that. A good example would be $100 stop loss would be like 20, 30, 50, for example. The numbers you actually use do not matter too much, but you absolutely need to go equal or heavier on DCAs, and your DCA should include that 1R. So how would I do this on this exact trade? Let's say entry 3057, stop loss, that's the right way, yeah, 2718. So entry 3057, stop loss 2718. How you do that when entering this trade is you give yourself the number your DCA should be, right? So the entire stop loss should be minus 1R. I have 1 DCA, so 1R on $1,000 account, 2% is $20. That $20, I'm going to divide that into 2 parts, with one heavier, one lighter. I'm going to choose $8 and $12 because I like those numbers. They are round numbers. You can do 10-10 as well. You can do 5-15 as well. Whatever works for your system, heavier or equal. Somewhere along the lines of 1.5 times heavier, 1.7 times heavier is like a sweet spot. So let's do $8 and $12, right? So my first entry is going to be $8, so can't actually do that with these numbers, I think. Okay, it's going to be $10 and $10 because the margin is too small to actually do that. But it's going to be $10 and $10, right? So on my first entry, that is going to be a 95 position size position because I want my stop loss to be that $10. Because the entire position is going to be the $20, not just the first entry. Otherwise, you're going to be way heavier on positions with DCAs, and you don't want that. You want consistency. So I would just put this in as a limit order, and just leave it be. That is limit order 1. Or is open long, that's limit order 1, right? Then I would go for the second limit order. I'm going to remove this one because it's unclear. And where's the DCA? The DCA is at 2.892. 2.892. So I have the same stop loss, right? I want $10 again, so that's going to be a bit heavier. That's going to be $200 quantity. That is how you should DCA with this system. So with 10-10, that means your first entry would be that, was it like 95 size, so the $10 stop loss. Your second DCA would also be the $10 stop loss. In a risk reward based system, just going equal makes sense because you're naturally gonna have heavier DCAs because your quantity is gonna be bigger. Your position size is gonna be bigger, right? So just going equal makes a lot of sense as well. So for a $20 stop loss, you would likely go 10-10. That is how you DCA in the system. If you have trades that are risk-free, stops move to break even, you can do more, right? Yes, you can do more. You can absolutely do more if your positions are risk-free, right? But what's it called? Something to keep in mind of is, for example, funding fees. For example, a market-wide crash where stop loss don't trigger, those kind of things. So even if your position is risk-free, take money out of your futures account every now and then. It's very important. Just like I said before, right? I have about 20% of my actual futures allocation in the actual account. I do not consider free positions to be active positions. So if I put my stop loss at entry, that is not a position anymore. To a certain degree. If I have like 23 positions for some reason, I am probably going to close a few of those just because like funding fees and whatever. I don't want to have 20 positions open as well. If I open my exchange and I see 20 positions open, I'm going to be like, wait, what's happening? Well, I want clarity as well, right? But technically for this system, no, those are risk-free positions. Those are not active. Something I do if I have a lot of, this is actually might be good advice. If I have a lot of open positions, I will simply move my stop loss very high on a few of them. Like, let's say I'm in this long, right here, and I have like 20 open positions, all of them risk-free. I will move my stop loss like over here to this wick, and then we make another low. I will now put it over here, and then we make another low, like right over here, right, this wick. I will now put it over here, to give it room to go up, but to also like be in very deep profit if stop loss hits. But no, if you have your stop loss at entry, that is now a risk-free position. You do not consider that as an active position to some extent. Okay, are there any questions about that or about the DCAs? Time to get my water. Just get it. It is way too hot out here. And for that as well, a position that is purposely opened into the opposite direction, I don't consider that as an active position. It's like kind of minus a half on my active position because a Bitcoin short is gonna have impact on altcoins as well, right? If Bitcoin goes down, my longs, like altcoins, will go down as well. So that is to kind of even it out. Okay. Uh, uh, uh. I think that was actually most I wanted to go over today, which is a good thing because we've been going for 2 hours and 15 minutes. I kind of said it at the start, right? I expect this class to actually be longer than usual. There's one subject I really want to go over, but I'm gonna do that next week because that will probably take like 2 hours as well. So I think if you guys have any questions, let's get those out now, and then I'll answer those. And then we already know what we're gonna talk about next week. That was the wrong chart. We already know what we're gonna talk about next week. Next week, I am gonna give a class on this very fundamental TA knowledge. That's something unrelated. Absolutely, go ahead. Yeah, no worries, guys. It's really nice that that so many people enjoy it. So many people enjoy the class. What is your core current short time frame for BTC? Yeah, my bias is short as well. It's like I think it's gonna go down, but I am not certain enough, and Bitcoin's not actually in a position where I will take a short. But if you would ask me up or down, I would say down. Is this recorded? Yeah, it was recorded. I'm gonna upload it on my YouTube. I will probably post it on Twitter as well. Wait, I have my desktop open. I have my desktop open anyway. I can show my Twitter. That's really nice. Yeah, I'm gonna post it. I'm gonna post it on Twitter as well. Probably gonna post the link. And a YouTube as well. Yeah, I'll send it. This is the Twitter. If I go on YouTube, I literally never use the YouTube. So whatever you see, it is not mine. What is it? What is on here actually? Hey, I do this in tomato. That's nice. Actually, good enough. Okay. Where do I do this? View your channel. I'm gonna leak something one day while doing this. And that is the YouTube. And then while we're at it, let's get everything out of one post, right? Gonna make a single shill post. Okay. I'm gonna everything I post is gonna be on any of these, right? So I'm gonna share the recording on my YouTube, and I'm gonna put it in my channel as well, just in Discord, and I'm gonna put it in the recordings channel. So that is gonna be right over here, and right over here. That's also where you can find all of the other recordings, right, from all of the other analysts. It's just in that recording tab over there. Yeah, don't worry about it. Freya is just like put up a pretty big message thanking me. I really appreciate that. I really do. It's like I really enjoy putting in the effort to do this, and I like seeing the positive reactions. Really, I really like that. Yeah, for sure. I'm gonna, because that's the thing. I wanna keep like actually like adding value to the live classes. So I'm gonna try and get more subjects like this in, because I know I trade a system that is rather complex to understand, right? Harmonics are absolutely not made for everyone, right? So I'm gonna make fundamental things as well. So something like this, I'm gonna focus more on this. I'm gonna end the recording here, by the way, because the class is kind of over.